Welcome and thank you for joining us for Unlocking Real Estate Deals with Creative Financing. My name is Randy Cochran and I am the Director of National Growth and Development with Equity Real Estate. And I love this topic. It's one of my favorite ways to sell properties. It's also my favorite way to buy properties. So we're going to be talking about creative solutions today, like rent to own. We're going to talk about land contracts. We're also going to talk a little bit about wraparound mortgages, and we're going to explain simple terms to you as well as how these transactions are structured. Now, with creative financing type transactions, you want to always be working closely with your title company, your title attorney, or your attorney, depending on what type of state you're located in across the country. Some states are what's called judicial, and some are called non-judicial. Some are going to be title theory states, some are going to be mortgage theory states, and we just want to make sure that whatever state you're located in, you understand the legalities of financing. So, for example, in some states, lease options are not even an option because of statutes and requirements. So just understand your legal frameworks for your market area and the state that you're doing these types of transactions in. So as we get started here today, again, my name's Randy Cochran. I'm the National Director of National Growth and Development with Equity. Equity is an independent real estate company, and currently we're located in 28 states. We have two more that are getting ready to open, and we're growing into all 50. And as we jump into our webinar today, why is owner financing so important? And owner financing has been around forever in real estate. And owner financing is really a creative tool that allows sellers to take the place of a traditional lender. So instead of the buyer getting a mortgage through a bank, they're actually making the payments directly to the seller over time. And what that means is the seller gets to become the bank. And what happens is this strategy opens up more possibilities for closing deals that may otherwise stall due to financing issues. Also, believe it or not, there is a huge benefit to the property owner oftentimes for offering owner financing. If they're the bank, what that means is they are maintaining a level of control of the property because they have a level of interest in the property recorded on title. And in addition to that, they are able to earn interest off their money just like the bank. And as I mentioned before, as we started the webinar, this is my favorite way to actually oftentimes list and sell a property as well as buy properties. As real estate agents, we want to make sure that we're investing in real estate as well. And this is really my favorite way to do that. And by offering creative terms, this transforms uh, the home into the opportunity for flexible financing. What it does is it separates a listed property from a sold property. And the reason why, especially right now, this is such a topic that we're this is such an interesting topic that we're sharing with everybody is because right now there are so many homes on the market, and there's more homes listed than there are buyers. And the interesting thing is we're in a market that we haven't ever been in before, or at least not for a long, long time. And the reason why it's a perfect storm for this type of financing is a couple reasons. The first reason is that prior to and during the pandemic, a lot of the mortgage loans that were done by the property owners, the interest rates are between 2.5% and 4.5%. So what we saw the lowest interest rate really in the history of mortgage lending. And we have a lot of property owners that because the interest rates did come up, the market is adjusted. And what's happened is because the market's adjusted, they have little to no equity in their properties. And so they are in a situation where they have to bring money to closing. If they don't have the money to bring to closing, we're back to a short sale environment. meaning that the property is getting sold for less than what is owed, and the bank is agreeing to release the lien on the property, which still may have the property owner still be liable for the balance or the difference. So that could create a financial burden for the property owner, but also we not only have all these great mortgage loans out there at a low interest rate where we can take advantage of the property owner carrying the note at that lower rate, but also there is what is being called the silver tsunami coming, and that silver tsunami that is coming is going to be the uh, the baby boomers that are 60 plus years old, and the majority of those properties, about 60 to 70% of all those properties that are owned by the 60 years and older property owner are paid for. There's no mortgage balance or loan at all. And what this allows a property owner to do is sell, continue to collect revenue for their living expenses, earn interest off their property that's paid for, and at the same time is is still a benefit to them because now they're able to sell the property, exit, and move on to oftentimes single level living. So we kind of have this perfect storm going on right now where a lot of property owners and have not been open and receptive to owner financing, which they now are. But also the purpose for this webinar is for us to educate you as agents and brokers to know how to talk to the client about why this is actually a benefit to them. And as we jump in today, as I mentioned, have a pen and notepad close by. We're going to talk about different levels of owner financing. We're going to talk about a couple different scenarios. And then I'm actually going to share a transaction that I did personally on owner financing. It was actually the first property that I ever purchased. So let's jump into the different types of owner financing. And owner financing comes in several forms, each designated to solve different buyer or seller challenges. So whether you're looking to close a deal fast, bypass traditional lending, or create passive income, there is always a structure that can work for the property owner. The first and lowest form or level of owner financing is doing a rent to own. And a rent to own and a lease option can often be times can be considered the same thing, but at the same time not. Because with a rent to own, you could literally rent the property to a property owner with the agreement that they could purchase it later on, having that first right of refusal to purchase. And you can take a portion of the rent and apply that towards the purchase price or towards the down payment on a property. If you're typically doing a rent to own with a tenant, you can typically get a little bit higher rent if they know that at some point in time they might have the opportunity to purchase a property. And of course, one of the reasons why they may be renting is because they're not in a financial position where they can buy yet. It could be their credit score is low. It could be their income to debt ratio is high. It could be they have student loans that they're paying on that they might have to pay off, or it could be a combination of all those things. With a lease option, it is very similar to a rent to own, but the buyer must exercise the option within a specific time frame or they lose the right to purchase. And with a lease option, you want to make your lease options closed-ended so that it does force the person that is leasing the property to take action with a deadline. Also, typically they're giving you a deposit up front for the option, or they could be increasing that over time through the lease agreement for the option. But typically with a lease option, whatever amount of money that they're putting down for the option typically becomes non-refundable. And again, this could be an additional source of income for the owner or incentive for them to do the option. The next is what we call an installment contract. And depending on where you're located across the country, this can be called something different. It's not always called an installment contract, and it can be called a land contract is another term, and another term is a contract for deed. What these are, these are what we call a synonym. If you remember your vocabulary lessons from school, And what that means is these are different words that basically all mean the exact same thing. And with these types of owner financing, the buyers make the payments directly to the seller, and the title transfers to the buyer once the final payment is made. So during the installment contract, land contract, or contract for deed, everything's going to be in writing. It's going to come to a meeting of the minds. Your real estate title company or your real estate attorney is going to close the transaction. And the property owner is going to remain on title to the property, but that buyer has what we call equitable interest. And with equitable interest, what that means is that the person that's executed the agreement has the authority to sell the property. They have the authority to rent the property. And unless there's specific language in that type of agreement that does not allow that buyer to do that. With the land contract and contract for deed, an installment contract, oftentimes this puts the property owner's mind at ease because they know that they're still on title of the property, which gives them a level of control. The next type of financing is what's called a trust deed and note. And the trust deed and note is where the seller continues to carry the loan while the buyer receives the deed, so they do go on title to the property. The buyer signs a promissory note that's secured by the deed of trust. And again, your title company or attorney is going to prepare this document. They're going to record it with the county, and your buyer is going to take control of the property. Now, the property owner, they still have that note recorded against the property. If the buyer does not pay, then the property owner that has the note against the property, they can initiate a foreclosure action, go through the process, foreclose on the property, and get the property back. The next type of owner financing is what we call an all-inclusive trust deed and note. And basically what we're doing is we're wrapping the existing mortgage into a new loan that's held by the seller. The buyer makes one payment to the seller who continues to pay the underlying mortgage. Now, sometimes if the property owner has equity in the property above the current note that's due with the lender, then their payment would be getting paid to the underlying mortgage holder on a monthly basis when the payment's due, and then they're paying that other note or the second mortgage to the owner. And these are very common transactions. A question that we get a lot when it comes to the all-inclusive trust deed and note is, well, I've heard that there's a due on sale clause with all mortgage companies, and that is true. Since 1978, there's been a due on sale clause in pretty much every type of mortgage loan that's given. Some loans, for example, VA loans, they can become fully assumable, and that allows your buyer to go in and actually take over the VA loan directly with the lender. And of course, that's a process. And if you do that type of transfer of ownership type transaction, if you list the property and it's a VA loan, you want to start that VA assumption as soon as you list the property because it can take 4 to 8 weeks. And then once the buyer steps in, then they can start their paperwork process. Those transactions definitely take longer because your buyer is actually taking over that mortgage loan through the VA process. Now, a question that we do get about that due on sale clause is in most cases, if the lender's getting the payment, they're not typically calling the note due. In over 24 years of being a real estate broker, I've personally only saw two notes called due over that period of time. And both of those notes that were called due, where the owner financing took place, both of those notes had fraud in them by the previous mortgage holder. Not, it wasn't the buyer issue, it was the mortgage holder. So you want to talk to your title company, you want to talk to your uh, attorney. They'll help you structure these types of transactions correctly. You always want to make sure in these types of contracts that the property owner is still the insured on the property and that your buyer becomes an additional rider on the policy. Also, if a property owner has this all-inclusive trust deed and note, an incentive there for them to do this type of transaction, if your buyer takes over their payments, is let them continue to take the interest benefit that they get for paying on the note with their mortgage lender when they get that statement from the IRS every year for their taxes, let them take that deduction. And that could also be a benefit to them. Also, one of the concerns that we get a lot with this type of transaction is they say, Randy, what if the buyer doesn't make the payment? Or what if the buyer gives the property owner the payment and it has an underlying mortgage note and they don't make the payment and the property goes into foreclosure because the payment didn't get made. And here's how you do that. You're going to always use a third party escrow company that your buyer or the property buyer is going to make the payment to. And then that escrow company, they're going to pay the mortgage payment every month. So we're never giving the money directly to the property owner. It's going to that third party escrow company. This protects everybody in the deal. And then that company will pay the mortgage. And then if there's a difference, they're going to pay that difference to the property owner on a monthly basis, which gives them cash flow and their profit from selling the property. Also, if your property owner or seller is hesitant because they say, well, what if the buyer doesn't make the payment? One way to put their mind at ease is when this transaction closes, have your buyer escrow two payments with the escrow company that's sitting in their escrow account earning interest. And then that way, if they don't make the monthly payment, there's at least two payments sitting in escrow, and that gives you really a 60 to 90-day period of time to remedy any type of non-payment. And of course, is there always a risk that somebody buys a property, whether it's owner financing or regular financing with a mortgage lender, and at some point they have a challenge and they don't make a payment? That can always happen. But if you structure these transactions correctly, it's actually more beneficial to the property owner knowing that they have money in escrow and sitting there for payments, because oftentimes people, if they miss a payment, they're behind for sometimes forever because they didn't have the funds to get caught back up, and that's why we end up with with pre-foreclosure properties. Also, one of the huge benefits to this type of transaction is there is no appraisal done at the time of the closing. Of course, you can do your comparative market analysis for your client or your BPO. If the property buyer chooses to, they can still do an appraisal and pay an appraiser for that so they know the value. Oftentimes, with a lot of these transactions as well, if especially the lease option or the rent to own, those purchase prices may be based on a value at some point in time in the future. And of course, all of these things are going to be the uh, in the offer to purchase as well as the note. So let's go through a few different types of owner financing. The first scenario is Sally, seller, owns the home outright. She agrees to sell it for $100,000 to buyer Barney. Buyer Barney puts down $5,000 and signs a promissory note for the remaining $95,000. Sally delivers the deed and records the mortgage lien against the property. And of course, you would want a title company or attorney again helping you facilitate this so it is done correctly. In this case, Sally becomes the lender and she receives the monthly payments directly from Barney. Because there's no existing mortgage, the process is simple. It's controlled entirely between the two parties, and Sally can include a balloon payment clause requiring Barney to pay off the full balance within a set number of years, oftentimes 3 to 5 years. So what will happen is oftentimes these notes, and of course these are pretty low purchase prices. We're not going to see these commonly around the country, but we're just using these numbers for examples in simple math. But oftentimes these types of transactions, they are amortized out over a 10, 15, 20, 25, or 30-year period of time, and then typically do have that balloon payment where they're exiting. Now, some of these, oftentimes, these types of notes, a lender is willing to carry the note the full term. Could be 10 years, could be 15, could even be 30. But oftentimes what happens is you have to remember the average person refinances every 3 to 5 or 7 years anyway. And when that happens, the property owner typically gets bought out of the transaction. The result of this scenario is this approach provides Sally with passive income and full control over the terms, while Barney gets to purchase a home without the bank involvement and again without having to jump through all the hoops to get approved for a mortgage loan. This is great for business owners. We see this happen a lot where a business owner is paying themselves through 1099 income. They're expensing a lot of expenses for their business. It's very difficult to prove income sometimes, especially if it's a cash-based business. And this owner financing scenarios, as well as the others, are very favorable to that type of business owner buyer. The second type of owner financing is Sammy, the seller, owns a property. It's worth $100,000 with a remaining mortgage balance of $80,000. Betty buyer offers $10,000 down, but her lender only approves an $80,000 loan, and what that leaves is that leaves a $10,000 gap to close. Instead of dropping the price or relisting the home, Sammy agrees to carry a $10,000 promissory note at closing. Betty pays the $10,000 down, finances $80,000 through her lender, and now Sammy owns $10,000 through a second mortgage, and that can be paid over time. It can be a balloon payment. It's really whatever they agree on. Right now, we're seeing a lot of new construction doing these types of lending because the market on new construction in a lot of areas is dropping, and they're having to give up massive concessions to get new construction sold. Sammy now has two benefits. One, he closes the sale without delay, receives the interest income from the second lien. Betty, meanwhile, gets the home she wanted without having to find another lender or restart the whole process. Owner financing scenario number 3 is Susie seller owes $90,000 on a $100,000 home. While she could list the property and wait for a buyer with bank financing, it may take time and cost thousands in agent commissions. Instead, she offers owner financing to Barry buyer for $100,000. Barry puts down the $5,000, and Susie finances the remaining $95,000 at an 8% interest rate using an all-inclusive trust deed and note. Susie does not pay off her underlying mortgage. Each month, Barry pays roughly $700, while Susie continues to pay original mortgage at $600 at 6%. She earns $100 a month from the difference in the interest rates or the spread and keeps control of the process. So she's not only getting the home sold, she's cash flowing and earning money. This wraparound structure gives Susie consistent income and flexibility. Barry gets a home with manageable payments and no bank approval required. And of course, some of you right now are going, oh my gosh, as an agent, how do I get paid on these transactions? Well, everything in real estate is negotiable. And so we're either getting paid by the seller if we've negotiated that. And of course, our compensation can come from seller proceeds or equity. It can also come from part of the down payment that the buyer gives the seller, or our compensation can come from the buyer directly, where we're helping facilitate this transaction where they're compensating us for helping them buy the home, write the offer, negotiate the deal, fill out the seller financing addendum that goes over to the property owner. If it's a for sale by owner and we're just representing the buyer, or if it's going over to the listing agent, the listing agent's presenting it to the seller. So at the end of the day, commissions are negotiable, our compensation's negotiable, whether it's negotiated with the seller or with the buyer. And this is just common practice in real estate, especially now with the changes that we experienced in August of 2024. It's very important that you understand the wraparound type transactions, because the wraparound is where we're letting the seller offer the financing without paying off the existing loan. And again, the buyer pays the seller, or our suggestion is that third-party escrow company who continues making payments on the original loan. The seller earns that income from the interest or the difference. And sometimes they might not be earning any income. Sometimes what's happening is they have a property that they're actually upside down on the property, and this enables them to get out of the property. So I bought a property. I'm going to give you two scenarios of properties that I personally purchased using this type of financing. The first property that I found was a for sale by owner. And of course, I've been in real estate now since as a broker since really 24, going on 25 years. But prior to that, I was a real estate investor. And I invested in real estate for about 10 years before getting my license. And there was a for sale by owner that had posted their property online. And I called the owner and I had a conversation with them. And I asked them why they were moving. And they said, well, I'm moving for employment. At that point in time, it was the beginning of April. And they were moving from Salt Lake City, Utah to Boise, Idaho for employment. And I said to them, I said, what's going to happen if first of all, I said, how soon do you have to be in Boise, Idaho? And they said, I have to be there by the end of the month. And I said, okay, so it's early April. You got to be there at the end of the month. If you don't sell your property between now and the end of the month, what's your plan? And they said, well, I'm probably going to give the property back to the bank. And I said, whoa, before you do that, let's continue to talk. I said, first of all, why have you not listed this property with a real estate agent? And they actually said, I've interviewed three agents. They all came out to my property, and every single one of them told me that if I sold my property after the cost to sell and all the compensation, I'm going to have to bring about $10,000 into closing. And I don't have that money and I can't afford two house payments. So if this doesn't sell, I'm just going to move to Boise. I'm going to rent, and then I'll just give this back to the bank. And I said, well, you do realize if you give it back to the bank will foreclose on you. Or if you do a deed in lieu of foreclosure, that's the same thing as a foreclosure. They will now get a default judgment against you after they sell the property, and whatever that difference is, they could come after you for the balance. Now, some states have a non-deficiency, they're non-deficiency states, so if a property is sold for less than what's owed, they can't pursue again a balance against the property owner, or maybe the property owner has prepaid mortgage insurance that would cover the difference. There's a lot of different scenarios that could happen here. In this situation, this person did not have any mortgage insurance. Also, they were in a state where we are a deficiency state where the bank could easily go get a deficiency judgment and simply start garnishing their wages. Plus, it's going to destroy their credit, and they're not going to be able to get a mortgage loan for another 7 to 10 years. And so, what I said to this property owner, I said, how much is your monthly payment on your property? And he told me the payment, and I said, does that include your escrow account for taxes and insurance? And he said, yes. And so I looked at what the amount of his mortgage payment was, and then I went online and I looked at what rents were in that area where the property was. And I realized very, very quickly that that property would cash flow $300 to $500 a month as a rental. And so it really didn't make sense for them to give the property back to the bank and walk away. But they also didn't want to be a landlord at the same time. They just wanted to be done and out of the deal. And so I simply said, I'm on my way over. I went over and I looked at the property. It really didn't need a lot of work to get it rent ready. And so my offer to the property owner was this: I will buy your home and I will pay the closing costs to our attorney to close the transaction. They're going to do all the paperwork, and we're going to set up a third party escrow company. I will start making your mortgage payments to the lender, and within the next 36 months, I will either sell the property, I will refinance the property, or I will pay off the property. And the property owner said, oh my gosh, you would take over my payment and get me out of this difficult real estate situation? And I said, heck yes, because I'll just take the property, I'll turn it into a rental, I'll take on all of the risk, and let's just be partners in this deal. And so a week later, we closed the transaction with our real estate attorney at the title company. And before the property owner even moved out of the property, we were advertising it for rent. They moved out of the property. It was around April 25th or 26th because they had to be on Boise for May 1st for work. And during that 4 or 5 day period of time between that and the end of the month, We had a whole cleaning crew come in, our handyman. We, changed out all the furnace filters, made sure all the batteries, worked in the smoke detectors and carbon monoxide. And we got everything all ready to go. And then on May 1st, our tenant moved in. And so I had first month's rent, last month's rent, and security deposit the day before we had to make the first payment on the property. And that turned into a fantastic property. And that property we actually ended up selling to our tenant a couple years down the road, and they became a homeowner. So uh, that's one way that these transactions can work, and that's a personal example of one that I've done. Now, a common tool is the installment contract or land contract. And what happens with this type of transaction is the buyer gains possession, but the seller keeps the legal title. The buyer pays the taxes, insurance, and maintains the property. Title transfers only after the full payment. And again, it can include a forfeiture clause for default that if the property owner doesn't pay. Now, if you do have a buyer that is putting a certain amount of money down, depending on the state that you're located in, it may not qualify for this type of transaction because there could be too much equity in the property. But again, you want to talk with your real estate attorney or title company on how that works. So here's how you're going to structure these deals. You're going to write the offer to purchase. You're going to do a seller financing addendum. Typically, your board of realtors or your MLS is going to have these as a approved form that you can use. If they don't have one in your MLS or with your board, definitely get with the real estate attorney because they can draft this document. It's going to include the price and down payment. Everybody's going to know that up front. It's going to include the interest and the term. Typically, these terms right now are between 5 and 9%, and they can be sometimes 3 to 30 years. Sometimes they're shorter. It might only be 12 to 24 months, depending on what your buyer needs. And then the payment structure can be monthly, lump sum, or both. Also, the taxes, insurance become the responsibility and require proof that they're paid. And then the default terms are going to be written into the note and the purchase agreement on what happens, or the seller finance agreement, what addendum, what happens if payments are missed. With creative financing, it's just not about closing deals, it's about expanding possibilities. In today's market, flexibility is the deciding factor between a home that sits on the market and a home that sells. By understanding alternative financing options, both the sellers and the buyers gain more control over the outcomes. And whether you're an investor, a homeowner, a buyer, a real estate agent looking for alternatives to get your properties listings sold, understanding these tools gives you an edge. And don't overlook what's possible when you step outside of conventional financing. Oftentimes, the best deals are the ones created with clarity, intention, and creativity. And in the past, even though we've had buyers oftentimes that qualify for financing, whether it's USDA, VA, FHA, conventional, sometimes even jumbo, oftentimes, even though we have a pre-approval letter, they've met with a mortgage lender, sometimes owner financing is more of a benefit to all parties, especially if there's like capital gains issues for the seller that they might have to deal with and things like that. And so oftentimes what we'll do is we'll put a property under contract. Everybody agrees. We can still be moving forward with the mortgage loan, but what we're doing is we're calling up after all parties have agreed and just asking the listing agent or the property owner if they are open-minded to owner financing on the transaction, and if so, are they willing to have a conversation with our title company and real estate attorney because they're the ones that are really structuring the transaction. They're writing up all the paperwork. And we never want to be the source of the information as real estate agents. We want to be the source of the source as well as that as a broker. And so we want these third party experts and professionals answering the questions for the seller, answering the questions for our buyer. Now, I told you that I would share with you uh, my experience buying my first property on owner financing. At the time, my wife and I were dating. We decided we were going to try living together and rent a place. We went over to move in on a Friday morning. And when we pulled up with the U-Haul moving truck and got out to meet the landlord to get the key, instead of giving me the key, he gave me the deposit check back. And so we had nowhere to go. So I called up a real estate agent. That was a friend of my dad. He was one of our clients. His name was Bill. And I called Bill up on a Friday and said, "Hey, Bill, this is Randy, and I need to buy a house today." And of course, as real estate agents and brokers, if we get that phone call, we get excited, right? That's like the best phone call to get is I have to buy something today. And Bill said, "No problem. I'm on my way." And he drove over and he picked us up. We went out that Friday and we looked at 5 properties. And back then there was no electronic MLS. He had 3x5 cards in his coat pocket and a book of properties. We looked at 5 properties that day. I wrote offers on 2 of them, and the property owners had 24 to 40 hours to respond to the offers. And so that next Saturday morning, we got up. We were going to go out and look at 6 more properties on Saturday. And the very first property that we pulled up to 9 a.m. was on Angel Street. When we pulled up the property, um, Bill felt like it was a really good property, and I'd given him my criteria and what I was looking for and what my exit strategy was going to be by buying a property. Uh, and so we walked through the property. The property had an unfinished basement. It did not have a backyard that was in. It was about 9 months old. And the reason why the property owner was selling the property is their husband worked for a milk company here in Salt Lake City, and they had relocated here. He'd worked here 9 months and then got relocated to work for another milk company in Lake Tahoe in Nevada. And so uh, he was already gone and they couldn't afford 2 house payments. So the property owner was at the property when we walked through. There were boxes everywhere. Her and her sister were talking. I overheard them say that the moving truck was coming that day. And so what we did is I went out to Bill's car, and Susie and I looked at Bill and we told Bill, we want to buy this property right now while we're here. And he said, okay. He did not even hesitate. And this is what you get when you deal with a professional real estate agent or a broker. He did not hesitate. He went to the trunk of his car. He popped the trunk. He got out a contract that was blank. He hand wrote it. I initialed it and I signed it on the hood of his Toyota Camry. It was beige. I'll never forget it. I also wrote him a check for $3,500, and that was my down payment or deposit. He went back inside the property. He was in that property for 15 minutes and came back out with a signed agreement from the seller and handed me the key. And I moved in at 3 o'clock that day. And that's what you call a fast transaction because we didn't have to wait. My agreement was that I was going to take over the payments on the property and we would get all the paperwork and everything done with the title company and that following week. And but they were going to let me take possession, and that's what we did. My agreement was we would either pay the home off, refinance it, or sell it within 36 months. And so Susie and I, we did all the paperwork the following week with the title company. We moved into the property. We ended up finishing up the basement and all of the landscaping in the backyard. And because I'm a frugal person, Susie and I got married in the backyard on August 30th in 1991. And that was our first transaction. Then a little while after that, we put the property up for sale and sold it because our family was growing. And we did really well on that transaction. It was win-win-win for everybody. The property owner remedied a situation where they couldn't afford 2 payments. I got into a property where I needed immediate possession and I built equity very quickly. And then Bill, at the same time that facilitated the transaction, uh, got paid. And so it was win, 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 win. And that's all we're looking for in these types of transactions. And uh, on the screen right here, you can see why join a set fee brokerage. Equity Real Estate is a set fee company, although we have some other options available for agents in our company. with some of our brokers. Uh, with this type of creative financing, it gives you flexibility, but a set fee brokerage makes sure that you keep more of the compensation when you close these deals, especially when you're using options like rent to own, wraparounds, or installment contracts. Traditional commission splits can eat into your earnings. And if you're structuring smart deals, you deserve a brokerage that doesn't take a cut of your creativity. So, especially if you're getting paid oftentimes on these transactions by the seller or the buyer, and it's a flat fee that they're paying you, not a percentage of the commission. Remember, it's whatever you negotiate. We just give you more flexibility for your business. So I want to thank everybody for joining us today. If you have questions, please don't hesitate to call me 801-573-4935. You can also scan the QR code there in the bottom right-hand corner. You can schedule a 15-minute phone call with me online, 30-minute web meeting, or a 1-hour web meeting. And it doesn't matter if you're with Equity Real Estate or not. If you're watching the replay of this webinar on social media, you're on our YouTube channel, and this just is a level of interest to you, or you have questions, or you need help with a deal, it doesn't matter if you're with Equity or not, just give us a call and we will help you any way we can. So thanks again for joining us today. Everybody be powerful, be productive, and let's go close some creative financing transactions. See you soon. Bye-bye.